So we've already traveled through much of Learning Objective 4. Chapter 4 started with the adjusting entries. That meant that the accounts in the ledger were changed because any adjusting entry goes in the journal and those entries are transferred, posted to the ledger. So the adjusted trial balance needed to get done to make sure that our ledger is balanced. Once that's done, as you know, as part of your homework, you had to prepare those financial statements. These are basically your final statements for the period of time. Um, and that's because you've already gone through the adjustment process and all this other stuff to get to this point where you're preparing final statements. You are going to prepare final statements monthly, quarterly, and annually. That means the longest period of time you will report your profitability, your and your retained earnings. The longest period of time you will report your income statement is a year. So at the end of the year, whatever you use, an accounting year like a fiscal year or the calendar year, at the end of that year, we have to go through a process of what we call closing the books. And that is what we're going to be talking about today. Okay. Let me go ahead. You already kind of know a lot about this. We did all this. All right. So this is listed as Objective 4b, at least in your textbook. Closing the books only happens to the income statement accounts, which are revenue and expense accounts. And at the end of the year, we also close our dividend account. Now, to close an account basically means we're going to bring a balance to zero. That's what we mean by closing the books. And the only accounts that are affected are the accounts that are folded into retained earnings. Remember, revenue and expenses are your income statement accounts, right? That gives you your net earnings, net income. We subtract dividends on the retained earnings statement. And then all of that gets transferred to retained earnings, which is a stockholders' equity account. So there are accounts that are temporary, like the revenue accounts on the income statement, like the expense accounts on the income statement, like the dividends account on the retained earnings statement. That once we're done calculating that, all those numbers transfer into what we call a permanent account, accounts that do not go through an annual period of needing to be brought to zero, which is what closing is. And of course, your permanent accounts are all on the balance sheet. Assets, liability, and stockholders' equity accounts are considered permanent accounts. They do not go through this process. This process is specific for what we call the temporary accounts, the accounts that are on the statements that measure the period of time temporarily. The income statement measures a month, a quarter, a year, but no more than a year. So after the year is done, we literally have to start a brand new accounting year the very next day, which means we have to keep our records separate. In order to keep the records separate, we have to bring these accounts to zero. So closing the books is really about bringing these accounts, revenue, expense, and dividend accounts, to zero. Now, again, the word accounts is listed here. There are many different accounts. Now, so far in our company, we only know about service revenue account. But there are a lot of other revenue accounts, sales revenue and ticket revenue and all types of stuff. Literally, if you are working for those companies at the end of the year, every single revenue account must be brought to zero. It must be closed to zero because the very next day you're going to start new records for the new period of time. Right? And you know how many expense accounts there are. I mean, just for Sierra Corporation alone, there were 6, 7 expense accounts. Each individual expense account needs to be closed to zero. Why? Because the very next day after a year, we have to keep new records that are separate from the previous record. So in essence, you're keeping track of revenues, expenses separately year to year. Think about when you turned, 17. And that year is like keeping a separate record for every day you were alive when you were 17, and keeping that record separate from every single day you were alive when you were 16. In essence, once you're on your very last day of your age 16, because the next day is your birthday, you close the record on age 16, because the very next day you turn age 17. So companies have to do the same thing with their income statement records. Their profit and losses can only go through that 1 year, and then they have to go through a period where they close, because the very next day represents a whole new accounting year. Very similar to after your last day of being 16 when you turn 17. That's it. It's a whole new year for you. So you have to think of it this way. Those are the temporary accounts. So they have to be zeroed out at the end every year. There is a process. It's actually a 4-step process in preparing what we call a closing entry. Again, everything is in, all these things get put in the journal, and then they travel from there, as you know. Closing entries, the whole idea is to get the revenue, expense, and dividends accounts to a zero balance at the end of the year, so we can start the new record fresh the very next day for the next year. Okay. And so the very, very first step in the process is we close our revenue accounts to zero, and we move these balances that are in the account to a temporary account called income summary. Income summary is sort of a temporary holding tank that we use in the closing process. We only use it during the closing process, and then we're done. Okay. The second step that we do is we close each and every expense account to zero, and we move those numbers over to this temporary account called income summary. Okay. Once we have closed our revenue account, the revenue account balance is now zero for all the revenue accounts. After we have closed our expense accounts, each and every expense account would now have a zero balance. Okay. What's sitting in income summary is all the revenue and all the expenses. So in essence, your income summary account sort of looks like your income statement. You see all the revenue on one side, all the expenses on another side. So it's going to be the exact same total numbers as you would see on an income statement. Okay. But again, like I said, this is a temporary holding tank. We don't need it anymore after we've closed the revenue and expense accounts. So the third step is we can close the income summary account by transferring whatever balance over to retained earnings. Again, to close an account means we want the balances in each account to be zero. That's closing. So the third step is to move whatever's left, which would be, of course, what's left is the difference between your revenue and expenses, which is your profit. So we're simply closing out your income summary and moving the profit over to the retained earnings account, which is what we do anyway. The retained earnings statement, the very first thing we do on the retained earnings statement is add the net income. We add the profit in, and that's all this is doing. And the very, very final step is this dividends account needs to be closed to zero, and we do that by moving its balance directly into retained earnings. Okay, so retained earnings is a permanent account because it's a stockholders' equity account. So we've done our job. Now, at the end of this process, and it's a 4-step process, after the first step, all of our revenue accounts have a zero balance, which means they are closed. After the second step, all of our expense accounts have a zero balance, which means our expense accounts have been closed. After the third step, we no longer need our temporary holding tank called income summary. We can close income summary and move the balance, which is going to be the net income, to our retained earnings. And the very, very last step is easy. We just take the balance in dividends, bring dividends to a zero balance, and move that over to retained earnings. And that makes sense too, because what do we do on the retained earnings statement? We add the net income, which is what this process is doing here, and we take away the dividends, which is what this process is doing here. Okay. How it actually looks in a journal is this. The very, very first step is to close the revenue account. Revenues have a credit balance. So to close an account means you want to bring the balance to zero. The only way balances become zero is both the debit side and the credit side need to equal, right? So $1,000 in, $1,000 out, the balance is zero. Yeah. So notice that on a closing entry, we actually debit the sales revenue account by the amount of money that's there. That brings the account to zero. And that's the purpose of closing. This only happens at the end of the period of time, most notably the end of every year for sure. But certainly you can keep separate monthly records as well. So we close we close out service revenue with the debit, and we move that money temporarily to income summary. Remember, income summary is just this temporary holding tank for this money until we close all our accounts. We don't need it anymore. Okay. The second step is closing our expense accounts, and each individual expense account needs to be zero. Expenses have a debit balance, and so to bring the account to zero, you have to make sure both sides of the account equal, which means you're going to credit each individual expense account by the same amount you see on the debit side. That gets it a zero balance. And then we move total expenses over to income summary. So look what's sitting in income summary right now. Total revenue of $10,600 and total expenses of $7,740. This is exactly what's on the income statement. This is the total revenue. This is the total expenses. So what's sitting in income summary is the same as saying, well, look at your income statement. It's the same as what your total revenue and total expenses are in your income statement. That's what's sitting in income summary. All right, income summary. Now that all of our revenue accounts are closed, all of our expense accounts are closed, we no longer need the income summary account. We can actually just close that. And to close the account means that the debit side of the account and the credit side of the account equal, so the balance is zero. There's an equal number on the debit side and credit side of the account, so the balance is zero. That's closing. Okay. So what's in the income summary account? Well, two things. There's this $10,600 credit sitting in the account, because after this is put into the journal, it would be posted into the ledger for income summary. And this $7,740 is sitting on the debit side. So basically, income summary has a credit of $10,600 and a debit of $7,740. So to close income summary means to bring the balance to zero. Both sides have to equal. Well, that means we're simply going to debit the $2,860, which is the exact amount of the profit, to income summary to close it. And we're going to move that profit over to retained earnings. So remember, retained earnings as a stockholders' equity account increases on the credit side. So this would be the same as adding the net income to retained earnings. A credit to retained earnings is adding to retained earnings. So this is simply the profit, the difference between the revenue and expense accounts is now being added to retained earnings, and we no longer need income summary. Now income summary has a zero balance. We don't need it anymore. I like to tell you the income summary account is like, if any of you ever have like Does anyone, have you ever had like a fish tank at home? Does anyone have a fish tank now? No, does no one has a fish tank, huh? Don't like fish? Too busy eating them. Okay. Well, you kind of know. Do you know anyone with a fish tank? Have you seen a fish tank? Okay. All right. So we're okay. So fish tanks are in your home, and of course, it's not like the fish walks to the door and say, "Hey, I like to be in your fish tank." Right? You have to go to the store, buy the fish. They put it in this temporary holding tank, this little bag, right? And then you get home, and you're supposed to then dump the fish in the tank after the water temperature is equal, and then you throw the bag away. You don't need it anymore, right? We're kind of wasteful. Sorry. But nonetheless, that's like income summary in this process. We were going to add it when we need it, which is simply to close revenue and expenses to zero. But after that's done, we don't need it anymore. We can dump it, and we dump it in retained earnings. Okay, very similar to that. The very last step, like I said, is to close out the dividends account. As you know, dividends has a debit balance. And so to get dividends to close, which means to get the balance to zero, you have to offset dividend with a credit and then move the dividends to retained earnings. Okay, move the dividends to retained earnings. This debit to retained earnings shrinks retained earnings, which is exactly what we do on the retained earnings statement, right? Retained earnings statement, we add in the net income and we subtract out the dividends. And this is exactly what we've done to retained earnings here. Okay. So once that is done, this is how it looks graphically. This is what the ledger would look like. Okay. So in the very, very first process, and this is also in your book this is on page 176 and 177. But as you see, the very first step is we close service revenue. Look how we close service revenue. We simply bring the balance to zero, and that means both sides have to equal for the balance to be zero. That's why the debit goes to service revenue, is because that debit combined with this credit will give it a zero balance. We move that to income summary, which is, again, that temporary account. Look what happened in step 2. We closed each individual expense account. Expenses normally have a debit balance. All of them do. So to close it means to bring the balance to zero. The credits of an equal amount in each account will bring the balances in all the accounts to zero. We move those total expenses, as you see here, to income summary. Now, income summary has total revenue on the credit side, total expenses on the debit side. As you see, step 3 is now we have all of our expenses are zeroed out, our revenue is zeroed out. We no longer need the income summary account, so now we can dump it into retained earnings. Okay, it served its purpose. Now we don't need it anymore. We're going to close it. So we close it by making sure both sides are equal. Again, the closing is simply bringing the balance to zero in an account. So if you have 10,600 on the credit side and 7,740 on the debit side, to make both sides equal, you're going to be debiting the account by 2,860, which happens to be the amount of the net income, right, on your income statement. That brings this account to zero, and move that to retained earnings. This is the same as adding net income to retained earnings on the retained earnings statement. And the very fourth step is to close dividends. Dividends has a normal debit balance. We know that. So to get dividends to zero, we have to make an equal credit, and we move the debit over to retained earnings. This is the same as subtracting dividends out of our retained earnings statement. The retained earnings statement balance here is exactly the same balance we saw on the retained earnings statement that we did for Sierra Corporation just literally a few pages ago. Okay. If you look on page, let me just go to it. If you look on page 172, you'll see those numbers look awfully familiar. particularly when you look at the retained earnings statement. Adding the net income, which is the same as crediting retained earnings, subtracting the dividends, which is the same as debiting retained earnings, and the balance of 2360 equals exactly what you see on page 172. Okay. So those are your checkpoints. Your income summary checkpoint should be looking like your income statement. Your retained earnings checkpoint, this should all look like your retained earnings statement. They are connected. Okay. And then after we do all of this, now what we do is, and I'm not going to, I'm not going to do it with you here, is now all of our temporary accounts will have zero balances. And so we do something called a post-closing trial balance, which is simply we list all the accounts, and you'll see when you get to dividends, when you get to revenues, when you get to expenses, all those are zeroed balance. So this is just making sure we have all those accounts zeroed out, and that's why we do a post-closing trial balance. But I'm going to spare you some of that here. We did a lot. Look at what happened. This is all of chapter 3 and 4. All right. Analyzing, journalizing, transactions, posting, and preparing a trial balance. This is all chapter 3. Adjusting entries, adjusted trial balance, financial statements. Now we're doing closing entries. And then once we close them, those balances will be zeroed out in the revenue, expense, and dividends account. This is all chapter 4. So this is quite the cycle. And this happens every single period of time that we measure our income, particularly on a yearly basis. I'm not going to go through each step, but they kind of do that. Let's go ahead and look at the Do It exercise 4B, which basically summarizes what I just explained to you in closing entries. This is on page 179, and it goes over onto page 180 in your textbook as well. So Hancock Company has the following balances in, it says selected accounts. So they just put a whole bunch of accounts there on its adjusted trial balance. And you need to prepare the entry to close the revenue and expense accounts. Okay, well, accounts payable is a liability account. Liability accounts are not part of this process because we do not close asset liability or stockholders equity accounts. We only close revenue, expenses, and the dividends account. So as soon as you can identify this as, in this case, it's a liability, we don't need to pay attention to it because it's not part of the closing process. But certainly service revenue is. Matter of fact, it's part of step 1. The very first step is we close the revenue accounts, right? Rent expense is. It's part of step 2. We close the expense accounts. So is salaries and wages expense is also part of step 2. We don't do the dividends account right away. This is actually going to be the 4th step, right? Retained earnings is not really part of the closing entries per se, but it will. This balance will change once we add the net income and subtract out the dividends. Accounts receivable is an asset account. Asset accounts are not part of this process, but expense accounts are. So this is also going to be part of the second process. So again, it asks us to close the revenue account. Revenue is at $98,000. That's going to be on the credit side of the account. So how do we get it to 0? Debit it. So we debit service revenue by the same amount that's on there. That'll make sure that both the debit side and credit side are equal, which means now the balance is 0, and that's what closing is. I keep repeating that because I want you to know. And then we put that money in temporarily in income summary. Yes, yes? That's step 1 in a nutshell. Step 2 is we close the expense accounts. Now there are 3 of them: the rent expense, the salaries and wages expense, and the supplies expense. Okay. Each individual expense account needs to be closed to 0, but the total expenses are going to go with income summary. So the total expenses are actually $80,000. which is the salaries and wages expense, rent expense, and supplies expense added together. Now, again, your rent expense, your salaries and wages expense, and your supplies expense are all on the debit side of their accounts. So in the closing process, to bring each expense account to zero, we total it on the credit side. So now the debit side and credit side are equal, the balance is zero. Now let's look what's happening in income summary. These are the two things that are happening in income summary. We have the total revenues on the credit side, and we have the total expenses on the debit side. So this company obviously was profitable, because if your total revenue is 98,000 and your total expenses were 80,000, you had a profit of 18,000 for that period of time. So the third step should be to close that income summary account. We no longer need it because now our revenue accounts are zero, our expense accounts are zero. We no longer need our income summary account. And so basically we move that $18,000 from income summary over to retained earnings. Okay. Income summary has, again, that $98,000 of revenue on the credit side and $80,000 on the debit side. So to balance it out, it's a debit to income summary. And we're moving the profit over to retained earnings. The next step is to close dividends. That's easy. Dividends is simply right here. This is going to be on the debit side of the dividends account, this balance. So to get it to zero, dividends is going to need to be credited by that amount, and this will be moved to retained earnings. So we're going to debit retained earnings by the amount of the dividends, credit dividends account. Now dividends is closed. So if you just take it on a step-by-step basis and understand that only the income statement accounts are affected, revenue and expenses, and then the dividends account is going to be affected in this process. If you see an asset account or what, pay no attention, because it's not part of the closing process. We don't zero those out. So again, the closing process simply means to get the balances in those accounts to zero. And you know how that happens. If you had $1,000 of money in your bank account, you have to take out $1,000 to get it to zero. Yes. So that's all we're doing. We're just making sure that both sides are equal in the closing process. So to get revenue to zero, whatever's on the credit side must equal. You have to put a debit there, so it gets to zero. All the expense accounts have debit balances. So to get those to zero, each account needs to get an equal credit. Okay. Dividends is easy as well, because dividends is sitting on the debit side. To close it, you'll need an equal credit. All the extra money is dumped into retained earnings, because it'll look just like our financial statement. Okay. And do you see the connection between what I was explaining and the income statement and the retained earnings statement? Do you see those connections? Is it still foggy? I think you'll do okay. All right, any questions?